The EB-5 Immigrant Investor Program stands at a critical juncture. Following recent legislative updates and shifts in global economic dynamics, predicting its trajectory over the next 10 years requires careful consideration of policy changes, market demands, and regulatory oversight. This analysis outlines key predictions for the future of EB-5. The days of lax oversight are definitively over. Future iterations of the program will prioritize investor protection and national security, leading to more stringent compliance requirements. Regional centers will face mandatory, frequent audits, demanding higher standards for source of funds verification. Expect the increased adoption of blockchain or similar secure technologies for tracking capital deployment and job creation metrics, moving away from manual reporting. The ambiguity surrounding at-risk capital definitions will likely be resolved through clearer statutory language. While the immediate backlog reduction is a priority, long-term stability hinges on efficient processing. We predict a bifurcation. Direct EB-5 filings remain slow unless significant USCIS resource allocation occurs. RC-sponsored filings will stabilize at moderate processing times due to standardized documentation requirements imposed by stricter oversight. The focus of investment capital is expected to evolve, driven by both domestic infrastructure needs and geopolitical factors. While the TE designation remains crucial for the reduced investment threshold, there will be political pressure to ensure these investments genuinely benefit underserved communities, rather than simply serving as tax avoidance mechanisms. The future success of EB-5 is inextricably linked to verifiable, measurable community impact, moving beyond simple census tract mapping. Investment capital will increasingly flow towards sectors aligned with national strategic interests: green energy and infrastructure, advanced manufacturing, healthcare technology. The reliance on traditional real estate development will slightly diminish in favor of projects where job creation is more directly measurable through technology. For example, a venture capital fund investing in an early-stage software company might use metrics like code commits per quarter or user acquisition rate as supplementary evidence for job creation, alongside traditional payroll data. The primary source countries for EB-5 investors will continue to diversify, reducing reliance on any single nation. Furthermore, as other countries enhance their own investment migration programs, the EB-5 program must maintain its competitive edge through regulatory certainty and efficient processing to attract high-net-worth individuals. The next decade for EB-5 will be defined by maturation. The program will shed its reputation for regulatory loopholes and emerge as a more robust, transparent, and strategically aligned tool for U.S. economic development. Success for regional centers and investors will depend on adapting quickly to heightened compliance standards and aligning investments with national priorities.